Hello, we're back now, this third video for we're going to do an expense projection. So we're going to add expenses to our multifamily analysis worksheet. So the first thing I'm going to do is I'm going to click in this field right here and go to view, and I guess I need to let's see here, freeze panes. That's what I'm looking for, freeze panes. Okay, so now I can scroll up and down. We can keep the top row, the years showing, and whatever's in the left-hand side. Okay, so I'm going to go ahead and scroll up a little bit, and I'm going to go to my other worksheet. I'm going to go ahead and grab my expenses section and copy that, and I'm going to come over here to where I'm working. And I'm just going to go ahead and paste in the expenses. And like I normally do, I'm going to format the column width so that they all show correctly. Now, I want you to notice what I've done. I've got just like I had a growth rate for revenues, I have a growth rate line for each of the expense categories. Okay, so for taxes, I have a tax growth rate. And for insurance, I have an insurance growth rate, and so on. So there's logic to doing it this way, and that is that each one of your expenses may have, some of them will have, a different rate of growth going forward into the future. So what I've done is I've listed all of the kinds of expenses that you would typically have, and in many cases you won't have all of these kinds of expenses. So for example, if you're investing in duplexes or triplexes or single-family residential rental properties, you may not have any payroll. You may only have contractors. You may not pay for any utilities and those types of things. So you may not have all of these types of expenses. But for a large multifamily complex, you're going to have a lot of different kinds of expenses. So what I'm going to do is I'm going to go ahead and put a variable in for our growth rate, just like we have for the revenue growth rate. I'm going to put a variable in, but to start with, I'm going to tie everything to the revenue growth rate. So I'm going to do plus that. And so now I've put in the variable for the growth rate, and I'm going to, again, for the first year, because it doesn't apply to base year, I'm going to copy that variable. And then for every year after, I'm just going to copy the variable in front of it. So I'm going to go ahead and drag this on out. Now what I'm going to do is I'm going to make this row green, a light green, so that it is all in sync. And then what I'm going to do is I'm going to copy, well actually what I'm going to do is I'm going to make this variable fixed against this variable. So I'm going to put a dollar sign in front of the number 3 because I want to fix it to a row. All right, so now what I'm going to do is I'm going to copy this row, and I'm going to go down for every one of our variables, or every one of our expense line items. I'm going to go ahead and put in the predictive future growth rate variable. So now we have the ability to predict the future growth of an expense into the future. Now I'm going to go back over and I'm going to go ahead and pull the baseline year expenditures, and I'm going to pop those in the baseline year field. There we go. So taxes on our baseline year for this particular property were $350,000. Insurance was $111,975, and so forth. So to predict what is going to happen in the future, I'm going to take, and I'm going to predict the future for just this row, and then I'm going to copy it on down. So I'm going to take the baseline year, so plus the baseline year, times the multiplier for growth for the current year, 385,000. Now what I did is I took the previous field times this field. So if I just copy that and drag it on out, it's actually going to do the math perfectly for me. But one thing I want to do is I want to get rid of the decimals. So I'm going to click the little decimal button up here to make the decimals go away. So now I can take that row and I can copy it down, and we're going to get the same effect on each of the other expense items. Okay, so now we've got all the expense items predicted out into the future. So next I'm going to take the total expenses, and I'm going to go ahead and make this I like yellow for totals, and I'll do the same thing here. We're going to calculate net operating income. All right, so now I'm going to add up all of my expenses. So I'm going to hit the plus key, and I'm going to add plus the 350 plus this, 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 and that, and hit enter. So now that's my total for year 0 expenses, and I'm going to go ahead and calculate my net operating income. So I'm going to put my cursor in this field. I'm going to hit plus and come up and grab my net annual dollars. This is the gross revenue, and then I'm going to hit minus, and I'm going to come down and minus out the expenses, and that's going to show us a net operating income amount. And for grins, I'm going to calculate the percentage that expenses are of income. So I'm going to plus the expenses, hit the divide key, and I'm going to divide it by the income, and I'm going to hit enter, and you'll see that it's right at 50%. So now we've got a number of things done. All we have to do now is just copy. Actually, I can just copy all 3 rows at one time, bring them all the way over to the end, and now for grins, I'm going to make that bold. Let's see here, make it bold. There we go, and I'm going to make this bold. There we go. Had to click it a couple of times. And now what we're doing is we're getting our net operating income figured out, as well as a percentage. And because for the most part our growth rate in expenses is actually larger than our growth rate in revenue, you'll see that the revenue, if you remember from the previous video, we said the revenues are likely to grow 10% the next couple of years, then steady state out to 5%. We did that because we're trying to be a little bit on the conservative side. So that's what we did. But if I go ahead and put 1.05 here, that doesn't change. Well, it does change a couple of things that we had right here. But so now everything is 1.05, and everything grows out at the same rate. So if we come down and look, our 0.50 actually stays pretty close to 0.50. It really doesn't change much. And but the reality is we're going to have some fluctuation. Okay, so what we want to do is we want to come back and we're going to change this. We're going to change this to 1.1, and we're going to change, okay, so we changed those two to 1.1. I had those previously set up, but we're going to leave everything else for the moment at 1.05, and you're going to see that operating expenses as a percentage of revenue are actually declining, which means that we're becoming more, we're generating more positive cash flow towards the end of the 8 years. But let's now go in and look at each one of the line items. Okay, so your tax rate is, one thing. Your insurance is another. Your management is another. I'm going to come down to our contract services, and I'm just going to say that from an analysis perspective, again, remember, you've been provided with the financial statements and all the supporting documentation by the previous owner for the previous years, at least 3 or 4 years. So I'm going to presume that we've come up with a decision that because we're going to be making a lot of capital improvements, our repairs and maintenance and our contractor services are going to actually decline. So we're going to make this number $111,000, and that's going to be a big savings that's going to flow through. Now we're going to go ahead and let it increase at a given rate. Remember, all of our expenses are increasing at the same rate. We can also make potentially some other assumptions. We have a dollar amount for repairs and maintenance, and then we have a management fee, and we have a payroll fee, and we have an administration fee. There's a pretty good chance that you're going to be able to eliminate some of these fees. So depending upon how you want to define and what these are, you may be spending less because, and one of the reasons that when you acquire properties, one of the things you do is you try to cluster properties together to some degree. Often you'll do this geographically so that the burden of traveling to see the properties or administrating the properties is reduced. So generally speaking, you can count on getting some economies of scale after you acquire your first property. Your second, your third properties and beyond can give you some economies of scale. And so the probability is that you're going to be able to come in and reduce one or more of these expenditures. So payroll, $250,000. Let's think, what could payroll of $250,000 consist of? Well, let's say you have a 194 unit apartment complex and you have an on-site management team. Okay, so an on-site management team, what does that consist of? That consists of a property manager and at least a couple of assistant property managers. You have to have enough people there so that you cover the full week, and also that when somebody's on vacation, you have enough people to cover when somebody's on vacation. So what are those? And you also are going to have a person that does, at least one person that does property site maintenance. Okay, so what are the costs of those people? So a property manager is probably going to get paid something in the range of $60,000 to $80,000 a year, and also maybe receive some abatement or reduction in their rental because you're probably going to want them to live on site. So let's just say that let's just go with $60,000 a year plus some rental adjustment. Okay, what about the other two people that work there? Well, they're probably in the $40,000 to $50,000 a year range because they're learning the business. So you have one person at 60 and two people at, let's just say one at 60, one at 50, and one at 40. So 60 and 50 is 110, 40 is 150. Now we're at 150,000. Okay, so what about a property engineer or a general maintenance person for the property? We're going to have at least one of those for a property of that size, and that person is probably going to be in the range of, say, $70,000 a year. So 150 plus 70, you're in the $220,000 range. Okay, so the payroll is certainly not egregiously overblown. So let's say you don't have any real savings there in payroll. But in terms of administration and management, you may very well have, so administration and management, what's the payroll for? So you may very well decide that you can shave some costs in some of these other areas. And so what you do is you go through and you look at each one of these and you decide what the reality of your expenditures going forward will be. Now, I've got a category here for other, which is a pretty big bucket. And what I'm going to do is I'm going to leave everything alone, but I'm going to come in and say the following. Okay, so payroll taxes grow at 5%. Insurance maybe grows at 1.03%. Whoops, 1.03%. Your management costs are not going to grow much, so we'll put it at 1.01%. Your repair and maintenance costs actually should be fairly stable. So I'm going to leave those at just 5% for the appreciation factor relative to the the materials that you're purchasing. Your utility costs will. My dog is growling. Roxy, lay down. Come here, lay down. Hey, lay down. Okay, dog in the room. So your utility growth rate is probably reasonable at 1.5%. Your leasing and advertising costs. Here's one area where you can probably get some beneficial. If you're going to make an investment to improve the property, you're going to lower your turnover and increase your desirability. And so you're not going to have to spend as much money on your advertising expenditures. And in fact, the properties, depending upon what you do, should become just very attractive that people will see. So leasing and advertising, you probably can reduce that cost at least, say, 20%. So we'll make it $38,000, and we'll let that factor out into the future. Contractor services we've already talked about. Payroll is probably not terribly out of bounds. Administrative fees, you may not have any administrative fees, or you might have somebody in the office in your corporate office that does this, but this might actually go to zero. So if we do that, that wipes that out. And then if we leave the other in, so now we see that your cash flow is growing pretty significantly. So the point here is that if you have a separate line item for each expenditure and a separate growth rate for each expenditure, you can then go in and tweak the individual growth rates. You can tweak them both for the entire spectrum of time, as well as you can go in and tweak them individually based upon your understanding of your marketplace and how you're going to run your business. So the expense portion of the spreadsheet should be designed this way to give you that degree of granularity. Now, this is actually all working towards building a either cash flow projection portion for a prospectus, an offering prospectus, or for the business plan that you're going to use to run the property that you're getting. And this is an ideal way to be able to, for your own planning purposes, be able to get very granular. And for each one of these expense items, not only should you have logic in your mind as to how it's going to play out, but you should have the logic written down in a 2 or 3 sentence or a paragraph that describes the behavior of that expense going out into the future and why you expect the expense to behave in that manner. This does 2 things. One, it forces you to think about the expense in a detailed, granular fashion, but it also gives the prospective investor, the person that, if you're using this as an investment tool, investment garnering tool, part of your prospectus, it gives the reader a thorough understanding of how valid and well considered your thought process is, to give them a greater level of confidence into the accuracy of the projections that you're putting forward. Because remember, there's only really only three ways to make more money in any business and in real estate in particular. One is to get more customers in the door. That's through advertising activity and also by reducing the churn or the rate that people leave, and thereby reducing your vacancy rate. Number two is by increasing the amount that people pay, and that is by improving your property and then by controlling your costs. And so this is a big part of how you're going to squeeze extra cash flow out of the property long term. All right, so now we have net operating income, and the next video that we're going to do will be dealing with the capital structure, where we take the net operating income and we do an analysis on it so that we can look forward into time and see what our probable return on investment is. So come back for the next video.